Hello, this is the teacher week 3. Let's go. For this week, I chose topic corporate fundamental analysis. I chose it for the reason that I find it essential for investors to make this kind of analysis when they are choosing active investment strategy, but not just investing into indexes, because if we deciding to manage our own money, we would need to make sure if the decision is reasonable. Fundamental analysis consists of 3 layers. The first would be economical condition, is just a bigger picture to look at, because even if the company has a good product, good management, and good market, potential customers, if the economy is in crisis, it would be the way harder to make good income and pay dividends. Next would be industry dynamics. I think even now with maybe AI agenda, many industries are getting restructured, and it's just good to be aware of things that are going on right now in the whole industry. And finally, it would be company-specific analysis, looking at financial statements. And there are 3 kind of statements people usually look at. First is income statement. It shows if the company is making any income, if its spending is lower than revenues. If on this step everything looks fine, next thing would be looking at the cash flow statement, because some companies manage their cash in the way that even they have positive income, they get bankrupt. So just it's good to know where the cash goes exactly and how much. And finally, balance sheet is always thing to look at the amount of assets, amount of liabilities, and the shareholders' equity. Because from shareholders' equity, dividends are paid, and it's just important to understand how the company is by looking at all 3 of those income statements. Just some metrics people usually look at. Revenue, it should grow over time, not remain the same or decline, because it doesn't make any sense to invest in company then. Profit margin, there are 2 types. Gross margin measures how much money company has left after producing its products and selling them. And operating margin would be would show how efficiently money is managed after paying for all operational expenses. Debt to equity ratio, if debt is too heavy for the company, it makes it vulnerable to economical downturns, and to also dependent on interest rates. And free cash flow, just shows where the free cash goes. Free cash is something what is left after all expensive. So it can be either be invested in development and expansion, either given to as dividends to investors usually. So now let's take a look at a couple of ratios. So price to earning is the ratio that is showing how much money company needs to spend to earn each $1 of revenue. It makes sense to compare with other companies in the field, because it may vary. Price to book ratio shows market price relative to liquidation value. And dividend yield, if it's a dividend, cash returns to dividends is too high, it maybe some kind of red flag for maybe some market concerns. Now beyond the numbers, there's some qualitative thing to look at. For example, the management quality. Even if you would look if the management owns a lot of stock of the company or not. If they don't, it could be a bit suspicious. And according to Warren Buffett's concept, you should always think of the company of its some kind of UVP, unique value proposition. So what makes company difficult to compete with for other similar companies? For example, it may have high brand power. Let's think about Porsche. Or it could have high switching costs. So long story short, what makes it difficult for other companies to take its customers? And now it's a couple of I'm watching time here. A couple of tools that can be used for this analysis. Finviz helps really easily to compare companies with each other in a visual way. Corefilm is basically a professional dashboard, but it's free. And the TradingView, we use it. It's good for technical analysis. There's charts and lots of visuals. So that was it. Thank you for your attention, and let's go to the next week.